Well, we got an all-time high for the US equity S&P 500. What is next? Well, we also got highs for the 10-year bond yield, or the 10-year bonds, but the yield is at the lowest. Everything is doing fine. Well, let's look at what happened really during the month of June. First of all, as of June 13, we got a new all-time high on the advanced decline line, which is the red line here that we can see. So that's usually precede all-time high from the price actions. Here what we've got is the New York Stock Exchange. We know that most of the time we got the price high first on the large caps, but not always. So here, the good things to remember is that divergences or failure to make a new all-time high with the advanced decline line by this red line would precede by 4 to 6 months a top in the market. So by making it right now in June, we almost have 6 months clear water. And of course, we know all that in May there was a kind of anxiety because the media were speaking about a lot of discussion on trade war and so on. And really what happened is during this month of May is that the red line here, which represents the selling pressure, people selling, compared to the black line, the buying power, that crossed for a little while, and then it again allowed the buyers to come back after they had cleaned up a little bit the price. And now demand, the buyers, is above the selling pressure. So what we've got on June 4 is a 90% up there, a strong return of volume and demand. That has been confirming the uptrend that we've got since December. Well, in fact, if we remember October, November, December of last year, we had already fears of recession. And that can be seen here with the black line. The black line is the ratio of cyclicals, discretionary sector, versus staples, more defensive sectors, staples. And when this ratio goes down, that means people rush for the safe play of defensive stocks, which go down less in case of a recession. And that's exactly what we got October to December. Then in January, February, March, April, it rebounded. And in May again, a correction, a decline, but a smaller decline than preceding one in October, November. And now, since June 3rd, a rebound. And this is good news. It's not all good news, because you notice that we need to clear the red trend line here, joining the highs, in order that people be fully convinced that there are less recession fear. We need to move still a few more percent. That means discretionary needs to outperform defensive stocks, staples, a little bit more. Then we noticed on the previous slide that we had the green area, which was representing the 10-year yield. In fact, here we've got a monthly chart from 2008 to 2019. And what we noticed is since 2016, the interest rates have been risen from 133 to 324. And since the late October last year, it moved back down from 325 to below 2%. And there is here a cloud which could offer some support, but really you see only black candles on this chart since the beginning of the year. And therefore, momentum is extremely oversold, as we can see on the stochastic on a monthly basis and also on the MACD. But you see also on the weekly basis, it is also extremely oversold. And there seems to be a lower low compared to the 2% level that we had in October. Therefore, here, nobody knows where it stops. Maybe some technicians can find a way that 185 is a key special number, a GAN number, and there is some short-term bullish divergence or slowing of the downside momentum. And therefore, maybe the people who are long the bonds should try to look at the charts just to be sure that they are not giving up all the gains they just have done since the beginning of the year. But that's for the coming summer and maybe late summer, and we'll see people all think that there are Fed cut in store. So they do not think about that too much of a rebound of the US interest rates. And there is no inflation, the economists are telling us. In fact, we have another worry, not only that the bonds are too expensive, possibly, or that the bonds cause a recession, but we noticed also that the relative strength of small cap versus S&P 500, and that's the red dotted line compared to the small cap index here, and that is coming down. That means small cap underperform large cap. And that's not a good sign, and that's basically the sign of an aging bull market. And therefore, in the coming months, we need to watch this underperformance if it will be maintained or if it turn around in the summer. Mid-cap are a bit less impressive. They are trying to bottom here on a relative strength basis, but still this is kind of a worry because we know that we would prefer to have small cap being very aggressive on the upside, so we would know that the bull market has still months to go. That's probably not the case. Sentiment was just kind of hedgy. In May, of course, it moved from 11 to 20% and has been moving back down. It's now, as the G20 is over, below 14%. You have to remember between 14 and 11, it's probably rock bottom, and there is a good support there. So watch out during the summer when the volatility is too low. It might be complacency sign. Now, another element is the US dollar index. If we look at this chart from left to right, what we see is something horizontal. That means a trading range, nothing specific. Then you see the technician has drawn all kind of lines. First, the red line, rising wedge, which has been broken. So it was basically telling that the dollar strength was kind of weakening. Then the red line here has been also broken, so people are starting to be afraid that there would be a dollar sell-off. And as the time, or as soon as people discuss that on the media, then you've got the rebound in the last few days. So basically, what we've got here is a technical tool called the cloud, the green clouds, and price are below it. So what we want to remember is that in this trading range, despite the momentum coming up very recently in the last 5 days, there is a bearish bias. And we will have to check if the US dollar is able really to rebound above 97 to change our view about this bearish bias. You'll notice that every time that the dollar goes down, like in June, that's helpful for the large cap of the US market, and that's usually come to save the US market in a very timely manner. But that's maybe just by coincidence. Therefore, short term, what do we have on the S&P 500? New highs, which we got here in July. How far can it go? 3,000 is just a stone throw away. We will probably see it. It will pull back to the former support, which was 29.65, 75. Usually that's what market do, and then rise again in the later part of the months. But what is important is try to recall what could happen for the next 6 months. Try to recall means by the fact that I have drawn 2 paths in the previous interviews, and now I'm revising them with the price action at new highs. And what we see here is a green path, which I prefer, but we definitely see that this is rather limited in scope. 3,200 maximum. And it also indicates that the summer is going to be good in the early part, and we have some risk of seasonality in the later part. And as usual, a pullback of 30% in October or September would not be a surprise. What would be a surprise, however, is a failure right now to move above 30,000, 3,030, and then start to grind down slowly like the red path already in August and September. I think that's less likely, even though that would not put in too much danger the whole long-term uptrend, but it would be certainly a surprise. So, remember, these are two paths, these are just two scenarios. I leave 10% probability for everything else, crazy. And here what we need to notice is what's happening in the coming 2 weeks if really the market are accompanying the good news that we just had last weekend. And the good news will depend, of course, on the Nasdaq, the technology, which has been impacted by the trade war, as you all know. Here, what you notice is that Nasdaq needs still to make higher highs. So the technology sector, the SOX, semiconductor sector index, needs to make new high in order to confirm and help this bull market expand. If it is not the case, that will be a sign of trouble. Globally, it's not going to be too bad right now. We notice that the relative strength of emerging market versus the S&P is kind of bottoming in the last month and a half. We still need to clear some resistances, but the path should be for higher prices, even though with some pullbacks. Here we need to differentiate among different emerging markets, but globally that's basically the big picture. Everybody is very negative about the global emerging market, about China, but we see as a whole, here the indices are not too bad. Japan is about the same situation. Relative strength was coming down. It's trying possibly to bottom right now in the last 2 weeks. Let's see if that's really the case, and let's see if resistances are broken up to accompany the US market in the summer. And the story is about the same for Euro. It was still on a relative strength basis underperforming the S&P 500. It's still the case. It's no big breakout. So there is no here strong sign of reallocating from the US to Japan nor to Europe. Here the price action is still neutral, let's say, and not yet fully bullish, even though we have moved above the cloud, which is indeed a positive sign. So let's see how the July will develop, and we'll talk to you later.